5 weeks.
And what about gold and, dare I say, crypto? I know that the last time we spoke on Twitter Spaces, I think you were scaling back on your Bitcoin exposure. Is that right?
So I sold my Bitcoin exposure a long time ago. And, I bought it at 4,000, sold it at 19,000. And if you think that sounds good, I saw it then go up all the way up to 68,000. Today it's around 23,000. Okay. So even, given what has been happening, I sold way, way, way too early, but that's years ago. And I haven't gone back in since. Look, Bitcoin, despite the big cloud hanging over crypto, is the best performer so far this year, up by 40%. And what that reflects is it's the high beta asset when risk appetite come back in force. And that's what we've seen this year. I'm not investing in Bitcoin, so I'm not the right person to ask. But again, you've had a 40% increase, and it has happened really quickly, which is the exactly same investment dilemma as you've had elsewhere. And that is the big dilemma right now. And it really forces you to take a view on the economics, soft landing, or less of a soft landing, and on the policy.
And what about gold?
Again, they all come down to the same thing, and this is where the market right now is going to have to make some difficult decisions, because the next stage of the rally is not as obvious as the first stage, and as I said, the first stage happened really quickly. So investors as a whole are sort of being forced into these corner solutions. Whereas really beforehand, they could be somewhere more in the middle with optionality. Now, increasingly, they're being forced into those corner solutions on economics and policy issues.
So Mohamed, what are you personally invested in?
I don't like answering that question.
That's why I asked.
No, I don't like answering that question because it gets completely misinterpreted. Just like I don't like answering the question, what do you propose I do? You do, because I don't know what your conditions are. I don't know, what your risk preference is. So they have to be very individualized answers, and they're not suitable for a forum like this where we have lots of friends and acquaintances and colleagues on.
Okay, so let's pivot to equities. We have seen a very strong start to the year for stocks, and there are a lot of traders on here. What is your overall view on the stock market?
I mean, it's been an amazing start, right? And if you've been in the NASDAQ, you've significantly outperformed the Dow and the S&P. If you've been abroad, it's, including in Europe, you significantly outperformed the US. And if you've been in last year's losers, you've significantly outperformed last year's outperformers. So it's not just that we've had this lovely rally in stocks, is that we've had quite a bit of differentiation that goes counter to not just last year, but in the case of Europe versus the US, many years. So that's the situation we're in. It is the soft landing trade that benefits the world as a whole. So this is where we are. Going forward, I think it's really important to be a stock picker and not an index picker. I think this is a world in which generalized investments, which was really the theme of the last few weeks, is going to give way to even more differentiation. And if you look at what happened to Meta today, that's a perfect example, okay, of what I'm talking about. So it really is a stock picking environment, and one needs to look beyond the US.
Mohamed, I had a question.
In the US and beyond the US, okay? Not just in the US is what I meant to say.
Mohamed, Aaron here again. I wanted to ask you what areas of the economy, if we're not in a recession, if we are going to have another rate increase, what areas of the economy do you see being squeezed the most, and which might benefit?
Okay, so let me take you to my baseline, because it does really matter what view of the world you have. So I think that growth will be anemic, but not in a recession. And I think that by the middle of the year, we're going to see inflation stuck at about 4%. And the reason why this will happen is because inflation has migrated, and that's the cost of the Federal Reserve being late. That's the cost of the Federal Reserve having mischaracterized inflation as transitory till the very end of November of 2021. And then when they started hiking rates in March of 2022, they started very slow. And then they were forced into the 475 basis point hikes. So inflation dynamics have changed. It started out being two products, food and energy. It then migrated to the goods sector as companies felt they had pricing power and they passed on the higher cost. Now it's in the service sector. The goods sector is disinflating. It is in the service sector. That is a very important change because services are less sensitive to monetary policy, and you bring in wages. And that becomes an important input into inflation. So because when I analyze what I think will be going on, and I want to judge, this is just my analysis, it can easily be wrong. I suspect we get stuck at around 4%. And that happens in the summer, the third quarter of the year, basically. And at that point, the Fed will have three choices. Choice number one is you crush the economy to get service inflation down. And that is the view of people who are telling us that the unemployment rate will go up to 5%. That basically the Fed is going to crush the economy to get to 2%. That's option A, which I think is not a good option, but that's option A. Option B, you recognize that the 2% target was arbitrary to begin with. It is not the target that you would choose today because there's so much going on the supply side. You opt for a target of 3 to 4%, which would be more appropriate. The problem with that is that no central bank likes doing this when it has missed the inflation target for so long. The ones that have done so in the past in developing countries have completely de-anchored inflation expectation. So they won't even talk about this publicly until they are in a stable inflation framework, which leaves you with the third choice. You continue to promise 2% inflation in the future. You see whether society lives with a stable 3 to 4%, and then down the road, you transition to that as an official target. That is the choice the Fed is going to have to make, in my opinion, in the third quarter. And it is not an easy choice.
And where do you stand on those three choices?
So I wouldn't crush the economy just to get to an arbitrary target of 2%.
Right.
I wouldn't increase the target when I'm way above it. So I would do number three. Look, there is no first best, right? We gave up on the first best when we mischaracterized inflation for so long, and when we started in such muted fashion. So when you're no longer in a world of first best, inevitably, whatever you do, second best, third best, inevitably, whatever you do is not just not perfect, but it also has unintended consequences. So yes, is it great to do it that way? No, but it sure beats the other alternatives.
I'm going to bring in Anthony DeRosa here. Hi, Anthony.
Hi, Jen. Hi, Mohamed. Thank you so much for joining us. I'm with Pensions and Investments. My question is regarding employment and the fact that the job market has been so resilient in the face of the Fed up until this point. At what point do you see the job market starting to show some cracks? It already seems like it's beginning in the last couple of weeks. Is that a big concern for you? And my second part of my question is, How, if we are going to be entering recession, if we're not already, do you think it'll be a shallow recession or it's going to be more of an extended one?
Thank you, Anthony, very much. On the first one, let me start first with what can go really well for the labor market, because we must not forget about that. And that is higher labor force participation. If we could get back near the peaks of labor force participation that we've had, we could have a soft landing. We could have all sorts of good things happening. That requires policies. And I must stress, there's another country where I'm speaking to you right now, the UK, where there's the same issue, labor force participation. People haven't re-entered the labor market. So they're trying an experiment, which is a really interesting one, that at doctor offices, they're going to have people who are going to ask you, are you in the workforce or not? And if your answer is not, they're going to encourage you to join back, the over 50s, as they call them. And they piloted that, by the way, in a very limited fashion, and I got 50% hit rate. So that there's some excitement about that. But the key issue is to increase labor force participation. For us, it's about skills, it's about childcare, it's about all the issues that keep people out of the labor force. If we can do that, Anthony, then we don't need to go through something very painful. I just want to put that, because we don't talk about that enough. We don't talk enough about what we can do to the supply side to make not only the soft landing more probable, but to make our growth potential go up. As to what can go wrong, well, we're starting to hear it, as you said, a whole host of layoffs. And what we're starting to see is that companies feel they have air cover. The more layoffs that are announced, the more likely you are to announce layoffs. And that is because every once in a while, companies go through labor force reallocations within them. Certain skills are no longer needed, and new skills are needed. And if you can have the air cover of layoff announcements coming left, right, and center, which they're starting to, then that encourages you to go forward. So that is the risk to the labor market right now, is that we see not only layoffs in terms of just the immediate business need, but also as companies reorganize their resources for a different world. And it is a different world.
Mohamed, what worries you the most about what's happening in the global economy?
I think a couple of things, and I just realized I didn't answer Anthony's question about if we get a recession, will it be short and shallow?
Okay.
I apologize, Anthony, and I'll cover it here. First is the growth dynamics. We really have a problem generating economic growth that is high, inclusive, and sustainable. We simply don't have potent growth models in most of the major countries, and that really worries me. And we need to find a solution to that, and it's not easy. It's politically not easy. From an analytical point of view, it's not that hard, but politically, it's not easy. So number one is growth, and you need only look at the IMF projections for, quote, subpar growth. Yes, they were less gloomy, but go beyond 2023, and you don't get much growth in this global economy. And we do need growth that is high, inclusive, and sustainable. So issue number one is the growth issue. Issue number two is what I call little fires everywhere, borrowing the term from somewhere else. And that's what's happening in the developing world. We're not paying much attention to it because they're little fires. We tend to pay attention to the big fires. But if you look at Ghana, if you look at Pakistan, if you look at Zambia, if you look at Ecuador, if you look at Egypt, if you look at Turkey, and I've missed a few because I don't have the list in front of me, there are things going on there that you need to pay close attention to. Now, little fires are fine as long as they remain little fires. What you don't want is the little fires to start joining up, contagion. That's why India today is something you got to keep an eye on, because there is a corporate, as we know, there's a corporate drama going on right now. And it is really important that that remains just a isolated focus case, because you don't want India, you don't want questions to start happening about India. You saw what happened in China when one of the most unexpected question I had to answer over and over again in 2021 was, is China investable? You certainly don't want to go there with other countries.
And you're talking about Adani.
I am.
Okay.
I had a question for you, Mohamed. Aaron here again. How worried are you about this, the debt ceiling fight over spending cuts? Is it just sort of the same old, or political posturing, or is there any real risk that you can see?
So, Aaron, I am in the market consensus. I don't think it will have lasting effects. I think it's more a political drama than it will be an economic or a financial drama. I hope it will be resolved. And if it's not resolved, it will be a repeat of what we saw just over 10 years ago, 12 years ago, that it then gets resolved pretty quickly, because people start realizing that it is a very unpopular thing for the American public. Okay, so it's very, very politically unpopular to tip the U.S. into a technical default when it's completely unnecessary. So I am with the consensus, and I hope that we are all correct. But that's where I am, Aaron.
Thank you.
Anthony?
Mohamed, following up on the question I had about whether it's going to be a shallow or a long recession, do you think if the Fed stays hawkish and they continue these hikes longer than you would like? I know you thought that they should have went higher this one and then stopped and paused here. What do you think that can impact whether we have a longer recession or not?
Yes, absolutely. So the nightmare solution, the nightmare outcome is the following: is that inflation starts going up at the end of the year, and I told you that there are certain people who believe that's going to happen, and the Fed is then forced to hike into a weaker economy. That's why I was among those. Just get them done while the economy is strong, while the markets are buoyant. Just get them out of the way, and then let the lagged effects come in. So the risk is, Anthony, and I'm not. I want to stress, this is a risk scenario. This is not my baseline. This is a risk scenario, but it's in response to a question, is that they are forced back into hiking when the economy has weakened significantly because inflation is heading back up. That's the risk scenario. And then you're not talking about a short and shallow recession.
And the way that the markets are reacting in a positive way, do you think that is giving the Fed some pause? And is that impact? Does the Fed look at the market reaction at all? Does that have any effect in how they respond in terms of what they're going to do next?
So I tweeted out earlier today, if there's one thing I would love to know, which is elusive, is how the Fed feels about what has happened. How does the Fed feel that the 2-year yield has plummeted 15 basis points? How does it feel about that? Okay, and that again was all the result of the press conference. How does it feel about that? We will never know for sure, but the one thing to look for is whether you get what you've gotten in the past with this Fed, which is after a few days, other Fed officials start correcting our understanding of what we heard. Right? But the key question, Anthony, is, how did I feel about the market reaction? I don't think they anticipated it, to tell you the truth. I just don't know about how they feel about it.
So, Mohamed, just to reiterate, you would have preferred a 50 basis point hike. That didn't happen. Now, what would you like to see happen?
Whenever things you want don't happen, and then you ask what do you want to see happen, you're far away from what you think is good outcomes. Okay, I suspect they'll hike 1 to 2 more times.
Well, the markets feel that way, Mohamed, right?
No, the market
I mean,
is much more dovish than that.
well, they're looking for. Do you think well, it looks like the markets are looking for cuts also.
Yeah, the markets are looking for at most 1 more hike.
Right.
And if this continues, pretty soon they won't even look for that anymore. And then they're expecting cuts from the middle of the year, whereas the Fed has told us over and over again they don't intend to cut. It is interesting that we don't fear the Fed. They've been giving us very clear signals, and the market simply has said, you're wrong. You're going to be forced to what we expect, Federal Reserve. So this is interesting. I don't remember such a long duration disagreement where the markets simply don't listen to what has been very clear and consistent Fed guidance.
So I know you have to go, but I did add Bobby as a speaker. Bobby, go ahead and ask your question.
Yeah, hi. Thank you. Mohamed, just a quick autopsy on the bear market and bonds. One of the things that is troubling is that if you look at total global debt and you look at the FTSE government bond index, the modified duration of that index has been rising steadily since 1990, going from about 4.5. I think at the peak it was an 8.8 duration. So what we've seen here is that price sensitivity to yield changes is greater than ever. Can we continue on that trend? And should central banks and other institutions be doing some sensitivity analysis? And, kind of if we do a shock to a stress test with, let's say, a 10-year at 7%, or a curve that stretches from 5% to 7%, what would it look like? Do you have any thoughts on rising duration?
Bobby, that's a great question. And you're getting both rising duration and a rising stock, right? So that makes it more interesting. And that's before you factor in QT. The Fed has so far contracting its balance sheet in a very orderly fashion by $500 billion. They wanted to make it seem like it's watching paint dry, and they've been successful so far on this. Yes, the answer is yes, policymakers should look at that. It's also the debt issuance department should be looking at that as well, because that has a debt issuance issue. The other thing you're doing, Bobby, and thank you for that, when we go beyond this year, what's inflation going to look like? What's growth going to look like? At some point, we've got to deal with the following things: the level of debt, the rewiring of supply chains, the persistent geopolitical tensions, the energy transition, and demographics. These are issues that we keep on pushing back. But if you are a long-term investor and if you are putting your money away and I'm going to force you into a certain scenario and you can't touch it for 5 to 10 years, you're taking a view on these things. If you're going into private equity, you're taking a view on these things. So thank you, Bobby, for also pointing out not just the day one issues, but the issues beyond day one.
Yeah, I'm writing a paper on the building duration risk